Hello. Today I'm going to talk about passive investing and the situations where I think it works really well, situations where I think it doesn't work very well, and then some of the risks that are around it that are very poorly understood. Those of you who know us will know that at the moment most of our portfolio is invested in passive instruments, and that's something that's probably not going to change in the short term. However, I do see some significant issues with them, and I will explain that in more detail today. Now, for anyone who doesn't know, a passive investment is one where the fund buys all of the underlying holdings in the area where the fund invests and buys them in the exact proportions they are in whatever that index is. So it's normally very low cost and it's relentless, and no decisions are made based on fundamentals. Active, of course, is the traditional fund management where you have a fund manager who's choosing funds based on the outlook for the performance of the company and the price of the share at that time. Now, over the last 30 years, passive has risen enormously in popularity. And actually, there are some parts of the world now where it's fair to say that it dominates investing. And it's changing the characteristics of how investment markets work in those areas. But before I cover that, let's just talk about why passive investing is good. I mean, the general thesis around it, it's very simple, is that passive investing will always track the index in the market in which it invests into, and is very low cost. And so therefore you reduce the risk of fund management error, and you generally have lower costs over time. And so on average, you'd expect that to outperform an active manager, the average active manager. The best market where we can see this operating is the US. And the US equity market now is the one which I think has the biggest issues, which flag up what the problems passive is going to introduce, potentially. So in the US market, about half of all shares, US equity market, half of all shares are now held by passive instruments. I mean, that's quite surprising to a lot of people. But the situation is more extreme than that, because actually most of the active funds are held by older people who tend to be quite often retired and are spending their money, and therefore those funds are in net outflow mode. And the majority of people investing in passive are younger investors who are investing every month through their payroll. And they're very much in inflow mode. So the net effect in terms of the flows within the US equity market is quite a lot more than 100% of net inflows come from passive. And that is, as you'd imagine, very significant. Now, what we've seen in the last 12 months, last few years, but accelerated in the last 12 months, is a very rapid run-up in the US equity market. And really, that's a very rapid run-up, not in profit underlying that, but in the share prices of the US equity market. Now, in a market which is dominated by instruments who don't make any decisions about what price shares should be or whether it offers a good prospect for future returns, I don't think that's that surprising, actually. And I think markets like that are much more prone to having periods where they are very overvalued or very undervalued. So that's the first thing I would say about passive investing. As an individual, whether you choose to go passive or not makes no difference to what the impact here is, because the markets that we now invest in, I think we need to be more active. So in my opinion, the US equity market offers very poor returns over the next few years, and we've taken action about that, and I expect that we will see this increasingly across the world in different areas. The second issue that I have with passive investing is about structural risk. So if you, again, imagine remember how the funds work. So there are no decisions being made and the funds hold hardly any cash. We've been in a world where markets have generally gone up and people have generally been positive about equity market returns and they keep on putting more money in. Now, what I'm concerned about is what happens when that situation reverses. So confidence is lost, or for any reason, for a period, these passive funds go into net outflow mode. It's very likely to happen when other people generally are nervous about investing. Now, in a situation where the managers do not care about what the price is that they buy or sell shares at, I think there's a reasonable, good chance that we'll see very sharp periods of losses in markets. Periods where outflows from passive funds drive down the values of share prices far more than people are expecting. Now, that is a very bad thing for all investors and fund managers, because one of the downside of investing, upside of course is you make good money over time, hopefully. The downside is that you've got to put up with ups and downs and volatility. If, as I suspect, we're going to see more volatility, that isn't something that I welcome. And again, but at least if we're aware of it and prepared for it, you can hopefully manage that more effectively than otherwise. There are a couple of other things about passive I just want to point out. There are some areas of the market of investment market, where actually I don't think it makes sense generally ever to invest in passive instruments. So I've got two examples. One is gold funds, which invest in gold mining companies. We hold one of these in our portfolios now. It's a very specialist area. It's not an area where I am comfortable investing in every share, every company in the market. And it's not an area it's very much an area that will benefit from fundamental analysis in my view. So I would never choose at this point an index or a passive fund investing in gold. And the second area is in smaller companies. The long-term track record of smaller company fund managers, active managers, is actually very good. It's a very specialist area again. The companies are poorly researched. Lots of prospects for mispricing of companies, and the history of managers is that they tend to perform pretty well in that market. So again, that's another market I wouldn't tend to favour investing in passive instruments for. Now, we don't hold any smaller company funds at the moment because we're slightly in risk off mode, and smaller companies are tending to be higher risk. But even when we do, I think you should expect us to invest actively in that area. So how would I summarise all of this up? Well, generally, I think passive is a good thing. If I didn't think it was a good thing, we wouldn't hold most of our client assets in it. However, it is changing the markets that we're investing into in a way that I don't think many people appreciate. And those changes are generally pretty negative. So I think we're going to see more periods of mispricing in markets, which is going to need us to be more active in terms of asset allocation. And I do think we're going to end up with periods where we get what to some people will be quite shocking losses for short periods of time, when if passive funds are in sell mode and there aren't enough buyers to mop up those excess shares. So generally they're a good thing, but if I was going to simplify it, I would say you've got to retain flexibility as a manager in terms of asset allocation and the kind of funds that you invest into. Now, if you find this interesting and you like the content, you'll see at the bottom left-hand side of the screen, there's a Flying Colours logo. Please click on that and you can follow us and see every video that we put out. If, as always, you have any questions about this, I am very happy to answer anything about any of this or any other topic. Please get in contact and I'll answer any questions that you have. And the last thing I would say is, as always, I am talking about investing, and you've got to be aware that your capital is at risk whenever you invest. Thank you.